What is going on, everybody? Welcome back to the Doggy Apps YouTube channel. And today we're going to be talking about, is this the Bitcoin bottom? So the strongest signal in the Bitcoin market right now is that it's not a green candle, right? It is what has failed to happen. So as you know, strategy has sold Bitcoin, the Clarity Act was delayed, and iconic crypto exchanges around the world are starting to shut down. And the Fed is still keeping money, like monetary policy, very restrictive. And the United States has just stepped into the Japanese yen market because the stress was beginning to show up inside our global financial system. So normally, that combination of headlines would be enough to send Bitcoin into another liquidation cascade. But Bitcoin here is still standing. And that might be the most important signal in the entire market right now. Because bottoms do not normally begin when everybody suddenly becomes optimistic, right? They begin when the same bad news that used to destroy the market stops working. So today, I'm not going to pretend that I do know where the exact Bitcoin bottom is, but I am going to give you, I'm not even going to give you price targets, right? Because this is not what we do on this channel. So this is more of a Bitcoin bottom checklist. And we are going to look at seller exhaustion, real market absorption, macro liquidity, stablecoins, consumer activity, regulation, and forced selling. And when you put all these signals together, the possibility that Bitcoin is building a bottom becomes much harder to ignore. So let's get started. So where we're at. But before we get into that, here is where we are currently at. At the time of recording this, Bitcoin is currently trading around $64,250,000, and the whole Bitcoin market cap is about 1.9 trillion, and the total crypto market cap is worth about 2.27 trillion, and Bitcoin represents nearly 57% of that entire market, and Bitcoin remains approximately 49% below all-time highs near 126,000. And that itself is not a small correction, right? The market has already experienced a major destruction of price, confidence, leverage, and attention. And I want to make one distinction early. Bitcoin can form a bottom before every altcoin does. Some weak tokens will continue failing and falling, but some of them will never actually recover. So when I say that this could be the bottom of the broader crypto market, I'm not saying every single coin suddenly has value. I'm saying that this may be the beginning to establish the floor that the rest of the market eventually builds from. And Bitcoin is still the reserve asset. It is still the collateral base. And it is still the emotional scoreboard for this entire industry. So right now, that scoreboard is damaged, yes. But it is no longer collapsing. And that is where the opportunity starts. Okay. So bad news is starting to lose power. And the first major signal is that the market is being given reasons to panic, right? And actually, it's not panicking the same way that it used to. Between August 3rd and August 9th, Strategy sold 1,690 Bitcoin. And that's approximately $100 million worth of real Bitcoin entering to the market. And Strategy still owns more than 840,000 Bitcoin. So this is not a company abandoning its entire thesis, right? These proceeds were like used to repurchase shares of the STRC preferred stock. They sold their Bitcoin to add to their cash reserves. But that headline still mattered because this is the company that spent years and years teaching the whole Bitcoin market, the world, that Bitcoin would be something that they should never sell. So when Strategy becomes a seller, the psychological impact was a lot larger than the dollar amount alone. Did Bitcoin react? Yes. But we did not get a regular, sudden collapse like we always do. We didn't get a huge, giant liquidation waterfall. And the market found buyers for more than 100 million Bitcoin, right? So somebody absorbed that supply. And then that itself is very important. Then we have the Clarity Act. The Senate left Washington without even completing the next major step. And the next vote is scheduled to be around September 15th. And that itself is not the final vote on the bill. It is a vote to limit the debate and to move the bill toward the Senate floor. And with the midterm election calendar closing in, the bill's chances of passing this year have become much, much more uncertain. Because institutions can already have Bitcoin through ETFs and regulated products, right? But unclear market structure still slows down the new business, new tokenized products, and new additional institutional capital. So that expected catalyst was still pushed further and further away. And once again, Bitcoin did not completely fall apart because Bitcoin doesn't need the Clarity Act. The Clarity Act needs Bitcoin. Bitcoin needs none of us, right? If you yourself don't want to buy Bitcoin, if you don't hold any Bitcoin, it doesn't matter. The market is not going to die, right? Because it has true and proven scarcity, verifiable scarcity. So, and on the right, then we have BitMEX. BitMEX is scheduled to close its exchange on September 23rd, right? But this is not just another FTX, right? Because there's actually no evidence that there's a hidden hole suddenly swallowing customer assets. BitMEX announced an orderly wind down and gave users time to close positions and withdraw. And its market share has already fallen below 1/100th of 1%. And that difference itself matters. Because every deep Bitcoin bear market seems to kind of have a funeral, right? In the earlier cycles, it was when Mt. Gox went down. Then it was FTX. Those are actually very catastrophic events because a lot of people lost their life savings. And this time, an exchange that was once sat at the center of a crypto leverage can disappear without taking the entire market class, asset class down with it. And so the casino is closing, but Bitcoin is still standing. And the market is bearing another piece of its old infrastructure without bearing the asset itself. When one negative event hits, prices can lie. When several negative events hit and the market keeps absorbing them, you have to start paying attention because good news tells you that you have a reason to buy. But bad news absorption tells you that people are waiting to panic sell. They may already be gone. The tourists might be already gone. So the market. All right, give me a second. My slides here got cooked. So now let's look underneath the price. Bitcoin is currently trading close to its median realized price. And in simple language, realized price data helps us estimate the cost basis of where most coins are being held. And Bitcoin is still below the average cost basis of many recent buyers. So the newer buyers, the new tourists who are in this asset class are now underwater. And underwater short-term holders are normally the most likely people to panic sell into a rally or dump their positions just to get their money back. And on-the-chain data itself is beginning to show something quite different. Bitcoin spot exchange volume measured in actual Bitcoin has fallen to its lowest level since Glassnode's data series began in 2019. So only around half of the Bitcoin supply is currently sitting in unrealized profit. And the seller exhaustion data is approaching, a cycle low territory. And that does not prove that the final bottom is actually behind us. That proves that buyers still need to show up. ETF demand remains relatively weak, and coins are still being transferred onto exchanges. And that doesn't tell us that sellers are getting tired, right? The market is currently not euphoric. It's not exciting. It's almost numb. And that is the bottom formation. That's what it normally feels like. Because people imagine the bottom as one giant red candle followed by an immediate recovery. But most bottoms are actually more annoying than that, right? They're actually quite more dull than that. There are weeks of failed rallies, low volume, negative headlines, and the market starts to become so bored that everybody gradually stops giving a fuck. And the Bitcoin gets so boring that posting a chart online feels so dull. It doesn't spark euphoric feelings anymore. But that boredom itself actually does matter. Because the bottom is not necessarily the moment that every seller disappears. It is the moment that the remaining sellers no longer have enough ammunition to push the market materially lower. And Bitcoin may be approaching that low now. So, see, wait, my slides are low-key messed up here, guys. So what would actually confirm a Bitcoin bottom? That doesn't mean that I need to give you a magical price level, because realistically, nobody knows. Nobody actually fucking knows where the bottom is, what the all-time high is gonna be. Nobody knows, bro. Like, I don't like, I don't really care about those type of theoretical, like hopeful numbers, right? I care about the change in behavior, because does bad news continue losing its power? Does the real selling continue getting absorbed? Like, do spot buyers begin returning instead of every rally being driven by leverage? Do ETF flows improve, right? So does the stablecoin value suddenly start to expand again? And can coins begin changing hands at a profit without the entire market immediately rolling over? That is what the confirmation looks like. Not one number, not one candle, and not somebody drawing a green arrow toward the top of a right corner of a chart, right? Because everybody likes that. Everybody likes to draw lines on a chart pretending they actually know where the price is going. But nobody actually fucking knows where the price is going, bro. A real bottom becomes visible when several independent signals begin pointing toward the same conclusion. The forced sellers are disappearing, demand is slowly returning, and the market becomes harder to push lower than it is to push higher. And that is the difference between making a prediction and recognizing a change in the market. Bitcoin is bottoming without a Fed rescue. Now we get the Fed. Our boy Kevin Warsh. I would not say that the Fed has no tools left. That itself is not accurate. And the Fed can still change interest rates and make money cheap. It can change the size of its balance sheet, and it can provide emergency liquidity. But the stronger argument is that the Fed does not have a painless tool. Like in the July meeting, the Fed kept interest rates between 3.5% and 3.75%. Three officials actually dissented because they wanted a quarterly point rate hike, not a cut, a hike. They wanted to make money more expensive, right? And July inflation came approximately about 3.4% headline and 2.5% core. So inflation is not moving in the right direction, but it has not disappeared. Since then, the weaker unemployment, retail sales, inflation data has caused the market to rapidly reduce probability of another rate hike. At the time of this draft, markets are pricing about only a 30% of a September rate hike. But economists are not only expecting a series of aggressive cuts. The base case is increasingly that the Fed simply holds rates where they are. They're literally just holding rates. Like, my thoughts are Warsh and the Fed are waiting for Trump to figure out what he's going to do with this Iran situation. Because as we said in previous videos, oil and energy is the cost of living, right? If oil and energy becomes more expensive, your life tends to become more expensive. But when oil and energy becomes more abundant and more cheaper, everyone's life becomes a lot cheaper. Because oil is literally at the center of our economy, and most people don't actually know that. To move anything on this planet, you need energy. And 9 times out of 10, that energy is going to be oil. But I digress. But I believe that's why they are holding rates and that they are not cutting rates. Like everybody knows Trump and Warsh are boys. So I believe that Warsh is hoping and waiting for Trump to do something on this Iran situation to lower the energy inflation, right? Because that realistically, that is one of the major things that is giving us our major inflation now. Like, cause things like, did everybody else in America, bro? Look at your go to your gas station and see how expensive gas is. That's all that needs to be said. So look at the Fed's choices. Cut too aggressively and it risks allowing inflation to accelerate again. Hike again and it risks putting more pressure on the economy and financial system already dealing with expensive capital. So what they've chosen to do is that they will hold rates where they are and let liquidity remain restricted. There is genuinely no magic button that they can press to save this whole situation. And that is why Bitcoin holding together matters. If Bitcoin needed an emergency rate cut just to survive, then it would be a fragile market. But Bitcoin can establish a floor while policy remains restrictive, then future easing becomes a potential upside. So it no longer needs life support. The bullish thesis is not the Fed is coming to save Bitcoin. The thesis is that Bitcoin may be learning it can survive without being saved. And the asset that survives restrictive liquidity becomes much more interesting when liquidity eventually improves. So the yen is testing global liquidity. Then we have one of the strangest macro signals in this entire market. A Reuters photograph, like what I have in the picture below, showed a note sitting on Treasury Secretary Scott Bessett's desk, and it said buy Japanese yen, $5 to $10 billion. Shortly afterwards, the United States and Japan confirmed that they have jointly intervened in the currency market. The U.S. Treasury sold euros to buy yen. Why should a Bitcoin investor care about Japan's currency or Japan's economy? Dude, it's because Japan is the largest foreign holder of U.S. Treasury securities. As of May, Japan held about $1.14 trillion of U.S. national government debt. And when the yen is also funding the currency behind one of the most important trades in global finance, the yen carry trade, here's a simple version. An investor borrows money cheaply in Japanese yen. And at the beginning of the yen carry trade, it was basically free. Like, you could borrow money for basically free. Like, it was 0% interest rates. And so what these huge institutions did and what these hedge funds did was they would borrow like $1 billion worth of yen and then buy US Treasury. And then they would pocket the spread. So if you were to buy $1 billion and then you pocket the 5% yield, that's still a lot of fucking money, man. Like, that is a lot of money. And sorry, I got distracted there. And then the investor uses that money to buy the assets, offering higher expected returns somewhere, like anything, stocks, bonds, credit, and sometimes crypto. And that trade works while the yen remains cheap and relatively stable. But then when the yen suddenly strengthens, the loan becomes more expensive to repay. Investors are then forced to reduce leverage. Then they sell the assets that they purchased. Then they sell what they can sell, not necessarily what they can buy or what they can sell. And that is how the currency move in Japan can become a margin call everywhere else. And Bitcoin trades 24 hours a day. It is liquid. It has no closing bell. So during a global margin call, Bitcoin can be the one that gets hit first. And Japan's treasury holdings add another layer. When Japan defends its currency, the market immediately starts asking whether it may need to sell foreign reserves, including U.S. Treasury securities, to raise more dollars. And the United States has facilities and other tools that can help Japan access dollars without creating a disorderly treasury sale. But the fact that this risk has policymakers coordinating tells you that how important the entire system and how connected everything has become. That means that the yen intervention is not automatically bullish for Bitcoin. A carry trade unwind can initially push Bitcoin lower. But if Bitcoin can absorb stress in the yen, the treasury market, global liquidity without creating another major breakdown, that becomes another piece of the bottom puzzle. Because this is not theatrical pressure. The plumbing is being tested in real time, and Bitcoin is still here. The stablecoin dry powder is still here. So the stablecoin fuel tank is still full at the current moment. Then we get stablecoins. The stablecoin market is currently worth about $302 billion, and that represents more than 13% of the entire crypto market. Now, I don't want you to oversell this signal because stablecoin supply is currently exploding higher. So this is not proof that the 302 billion is about to rotate into Bitcoin directly. Stablecoins are used for trading, payments, collateral, and international settlement. But a huge pool of capital remains inside that digital asset system. So asset investors can move away from volatile assets without moving completely back into the traditional TradeFi system. So the fuel is not being ignited, but it hasn't left the garage either. And that is why stablecoin growth is one of the most important confirmation signals that I am watching. Because if stablecoin supply becomes expanding while spot demand improves and bad news continues losing its power, then then that would suggest that new purchasing power is entering the market. For now, stablecoins are not the fire. They are just the dry powder. And here, slide number 9. This is one of my favorite slides in this presentation. So every revolution starts as a toy. And this next signal might be my actual favorite, because this is how transformational technology always normally develops. It always begins as a toy. So Bitcoin was once, magic internet money being passed around by cypherpunks and computer nerds and criminals. And people laughed at it. Then it became a $1 trillion monetary asset. The internet began with chat rooms, message boards, games, and people arguing with strangers under fake pseudonymous names. Now the global economy can't even operate without it. Social media first started as college kids posting pictures. Then it rewired advertising, entertainment, politics, and culture. The serious use case almost never arrives first. First comes the toy, then the users, then the liquidity, then the infrastructure, then the institutions. And that is how I look at consumer apps, meme coins, tokenized stocks, and RWAs, real world assets. I'm not telling you that meme coins are good investments, right? Most of them are not. Most of them go to fucking zero. But many of them will eventually become worthless. But the meme coin thing is not the thesis. The wallet is the thesis. The users are the thesis. The on-ramp is the thesis. The volume is the thesis. And the ability to settle value globally around the clock is the thesis. Right now, the speculative volume moving through these networks and these blockchains is honestly kind of insane for a market that everybody keeps calling dead. Right now, Robinhood is processing 400 million in DEX volume over 24 hours and over 3.1 billion in a week. Then we have low cap coins like Cashcat. So Cashcat is the meme coin native to Robinhood. Right, it is their version of Dogecoin, and it's sitting around 100 million market cap while producing a close $20 million in trading volume. Then we have one of my favorite current CTOs, which we have Ansem. You see on the right, that's our boy Ansem, the Black Bull right here, and Ansem is fucking sick, man. And right now, Ansem is trading around $300 million market cap, and producing $50 million in trading volume in 24 hours. So that means that this turning over more than a quarter of its circulating supply in one day, and those numbers can change extremely quickly. And I want to be clear: I'm not telling you to buy Cashcat, and I'm not telling you to buy Ansem, right? But both can reverse violently. Volume itself does not make token valuable, but that itself is not the point. The point is that near what we could have at the bottom of a brutal market, smaller speculative assets are becoming attractive to tens of millions of dollars in liquidity. And one random coin pumping, yes, can be noise, but heavy activity across many different coins, different applications, and different chains begins to take a breath. And it tells you that appetite to speculate has not disappeared. The users haven't disappeared. The liquidity hasn't disappeared. And the on-chain casino is still producing enough volume to test infrastructure in real time. But Ansem is especially interesting because it actually is beginning to develop into something beyond the normal meme coin. Ansem, officially called the Black Bull, is named after a crypto trader and an online personality called Ansem. He also runs the Market Bubble podcast with Banks. And he runs Bullpen and Ansem.io. And officially, Ansem didn't originally deploy the coin. An anonymous developer created it and routed about 65% of total supply along with the pump fund creator role to a wallet linked to Ansem. So they moved 65% of total supply to Ansem. And the allocation happened before public trading began. Ansem literally publicly embraced the coin and described what he did as a CTO. So in the crypto market, meme coin market, a CTO is basically a community takeover. Now, that 65% concentration is a real risk. It can't be ignored, yes. But it does mean an enormous amount of supply was placed under control of one person before the whole market had an opportunity to buy. And that makes the coin highly centralized around Ansem's decisions, reputation, and attention. So that is completely opposite to what Bitcoin is. So, but again, it's not Ansem coin. It's not the Black Bull versus Bitcoin. No. So this like so this is not a clean decentralized Bitcoin style asset like I said. It is almost completely the opposite. But what Ansem chose to do next is still worth watching a lot. Instead of immediately dumping the allocation or ignoring the coin, he embraced the community around it. He redistributed portions of that supply. He actually began running creator fees to holders and started building products on top of the attention that the coin already had. Now, just literally today, August 17th, he has released Ansem.io and something called the Z500. So Ansem describes the Z500 as the first on-chain index. Projects joining the system can commit part of their new token supply to Ansem holders, and they can buy and burn Ansem. And their commitments are displayed publicly before users decide whether to participate. So the platform itself is a trust and attention layer for token launches on Solana. And this is where the direction becomes interesting to me, because attention is one of the most valuable assets on the internet. But normally, attention disappears. Somebody posts something, it gets millions of views, everybody talks about it for a few days, and then the attention moves somewhere else. And what Ansem appears to trying to do is he's actually tokenizing that attention. His audience becomes a distribution network. Ansem holders became an on-chain community that new projects want access to. And instead of a project simply paying an influencer for one post and like multiple influencers for like UGC and whatnot, that the project can actually distribute tokens directly to the community. You know, they can burn Ansem and commit to a public ledger. So the attention becomes distribution. The distribution becomes liquidity, and the liquidity can start turning into actual infrastructure. So to me, that seems like a very, very interesting decision. And I am quite bullish on Ansem. Not because Ansem is guaranteed to succeed. Like, it is obviously not. You're still speculating on that. But the entire system here is quite new. It's highly speculative. And it remains dependent on one person's attention. And that supply concentration, yes, it is a very risky thing. But then if you watch Ansem and you follow Ansem, you actually start to understand of what a stand-up guy he actually is. So that does look like progression. Somebody launches a meme, the person behind the meme chooses to take responsibility for it, and a community forms around it. Then that person begins building tools, airdrops, token birds, leaderboards, and a launch system on top of a community. So the meme begins trying to become a network. First, people trade the joke, then people organize around the joke, then somebody builds infrastructure for the people who actually showed up. And that is exactly what I mean when I say the revolution always starts as a toy. And we are starting to see the same transition on a much larger scale. Applications like FOMO and Pump Fund are packaging crypto inside of products where like normal people can understand, right? So FOMO has almost 600,000 users and process almost $4 billion worth of trading volume, and like 70,000 of those people like made their first crypto purchase through Apple Pay. Think about how crazy that is. Like, these crypto native consumer apps are actually starting to blow up. And once the normies get their hands on speculative assets and get like a feel for what crypto is, then the saying is a rising tide lifts all ships. And I believe that this is the rising tide. So, like, the direction is actually quite clear here. People no longer need to read a 40-page technical document before doing something on chain. Simple. They download an app, they create a wallet, they see what their friends are buying, and they interact with the market that never closes. Yes, this first use can look very ridiculous. And this is always how the toy phase works. Then the serious assets arrive. Robinhood is specifically designed for tokenized equities, ETFs, private assets, and other real-world financial instruments. And Robinhood has already made stock token products available to eligible users in more than like 120 countries. Although those products are not available everywhere and don't provide the same legal rights to as actually owning the underlying stock. And on Solana, the value of RWAs has crossed almost already $3 billion. So cumulative token stock volume is already past $10 billion. So that is the transition. Like, meme coins are the arcade, and tokenized assets and RWAs are the financial institutions moving into the same building. So the arcade stress tests the wallets, it stress tests the exchanges, it stress tested the liquidity, and it also stress tested the transaction capacity. And it gives people a reason to learn on how this technology actually works. The institutions look at those same rails and ask, can we put stocks on this? Like, can we put treasury products on this? Can we settle ownership in 24 hours a day? First the toy, then the culture, then the liquidity, then the capital markets. And this is why the activity can be supporting a bottom signal, because it doesn't prove that the bottom is in, right? But a completely dead market doesn't onboard new users. It doesn't generate billions in DEX volume, right? It doesn't produce new consumer applications and attract serious financial assets onto the infrastructure. And Bitcoin cares because the more global digital ownership becomes, the easier it becomes for people to understand the digital scarcity. The apps will change, the chains will compete, and most tokens will disappear. But Bitcoin remains the scarce monetary asset without a company, influencer, or a development team standing behind it. And that being said, governments can regulate the doors, not the network. Then we have the government signal. So recently, Russia has suddenly become a Bitcoin freedom country. Let me say that again. Russia has not become suddenly a Bitcoin freedom country, but its framework is still controlled. Beginning of September, ordinary investors will still receive limited access to approved cryptocurrencies through regulated intermediaries. But they will face annual purchase limits like $3,000 and testing requirements. So using cryptocurrency for ordinary domestic payments remain prohibited. But Russia did not surrender to Bitcoin. It built a gate around it. It tried to build a moat around it. But China chose a much harder approach here. China imposed a broad ban on cryptocurrency transactions and mining in 2021. It forced exchanges out. It put pressures on miners, and it made participation significantly more difficult. But that didn't erase the Bitcoin network, right? By October 2025, estimates placed China back at approximately 40% of Bitcoin global mining activity, despite the official ban. So people still want this asset. People still want to own Bitcoin. And that doesn't mean the government restrictions are harmless. Governments can shut down exchanges, they can pressure banks, they can punish operators, and they can create enormous friction for their citizens to actually access these assets. But there is a difference between restricting access to a network and deleting the network itself. China built a wall, Russia built a gate. But neither one of those could make the whole network disappear, because Bitcoin does not become real when a government loves it. It becomes undeniable when governments that dislike it still have to develop rules around it. They can regulate the doors, they can regulate the exits, but the network still keeps producing blocks. Yo, what was that? Okay, so give me a sec, guys. Slides are low-key fucked. And forced sellers create bottoms. And I want to finish the argument with what just happened in the AI trade. So Leopold Aschenbrenner built one of the highest profiled bets on AI. So his fund situational awareness lost up approximately 6-7% in July, and it sold most of its publicly traded stock portfolio, and Ken Griffin's Citadel purchased a large portion of that book. So the hedge fund has also removed this leverage and think about the mechanism. Aschenbrenner could still be completely right about the long-term importance of artificial intelligence, but being right about the future does not protect you from leverage in the present. So when your positions are too large, your timeline is too short, or your financing disappears, the market doesn't give a fuck about your 10-year thesis. That may be eventually correct, because you become a forced seller. And Citadel did not need to know the exact bottom. It only needed liquidity at the moment that somebody else desperately needed liquidity. So This is how the bottoms form. The person who must sell eventually meets the person who could wait. And that brings us back to Bitcoin. Seller exhaustion is not approaching Seller exhaustion is approaching a cycle low territory. Spot activity has collapsed. Real selling is being absorbed without creating the same liquidation cascade. Old infrastructure is shutting down without proceeding to systemic destruction. And more than 300 billion still remain inside stablecoins. Consumer applications are onboarding new users, and new chains are generating billions in DEX volume. And smaller speculative assets are still attracting real liquidity, and Ansem is trying to convert attention onto a on-chain distribution network. And tokenized stocks and real-world the RWAs are moving onto the same rails, and governments that once tried to ignore or suppress crypto are now being forced to create frameworks around it. And Bitcoin is attempting to survive genuine stress in the yen, the treasury markets, and the global liquidity. And that itself is the meaningful checklist. This is not a guaranteed bottom. No, I'm not saying that it is the complete bottom. But the confirmation won't come it won't come from me giving you a price target, right? It will come from the market's behavior. Do negative headlines continue to fail to create major new lows? The spot demand replacing leverage speculation. Do stablecoin supply and institutional flows start growing? Does on-chain activity continue expanding beneath the surface? And when real sellers appear, does the market continue finding buyers? Because those are the signals that I care about. Those are the signals that I look at. So yes, this could be the Bitcoin bottom. Not because the news suddenly became good, not because the Fed promised to rescue everybody, and not because somebody drew a green arrow on a chart. This could be the bottom because sellers are getting tired. The market is absorbing real pressure. Risk appetite is quietly reappearing around those edges. And the infrastructure underneath those assets keep advancing while everybody is focused on the drawdown. At the top, everybody could see the opportunity. But down here, at the bottom, everyone can only see the risk. And when the price has fallen and the rails have continued expanding, stablecoins remain inside the system and consumer apps are onboarding new users, meme coins are generating real volume, new communities are being built on products on top of their attention, and RWAs are moving on chain. Governments are being forced to acknowledge the network, and real selling is being absorbed. Watch the behavior, watch the liquidity, watch the stablecoin supply, and watch the on-chain volume. And watch out how Bitcoin responds to the next bad headline, because bottoms are not announced by optimism. They are built when the market runs out of people left to scare. And I hope you guys enjoyed this video, and I'll continue making them if y'all enjoy it. And once we get a big enough community, we'll start doing these live and have more fun together. So comment down below and tell me what signal matters to you the most, and what other Bitcoin topics you would be interested in. So like, subscribe, and I'll see you guys in the next one. Peace.